One of the things I've always admired about you as an investor is that you don't talk about what should be. You figure out what is going to be, and then you do that. So what is going to be with respect to the stock market? What's going to
I
happen?
learned very early in my investing careers, I better not invest in what I want. I better invest in what's happening in the world. Otherwise, I'll be broke, dead broke. Well, what's going to happen is this is going to continue. Some stocks in America are turning into a bubble. The bubble's going to come, then it's going to collapse. And you should be very worried. But Henry, this is good for you because somebody has to report. So you have job security. You're a lucky soul.
Well, yeah, TV ratings do seem to go up during crashes, but then they completely disappear when everyone is obliterated. So nobody is hoping for that. But so when is this going to happen?
Later this year or next.
Later this year or next?
Yeah. Write it down.
And what will trigger it?
Well, it's interesting because these things always start where we're not looking. In 2007, Iceland went broke. And people said, Iceland, is that a country? They have a market? And then Ireland went broke, and then Bear Stearns went broke, and then, Lehman Brothers went broke. They spiral like that. Always happens where we're not looking. I don't know, it could be an American pension plan that goes broke, and many of them are broke, as you know. It could be some country we're not watching. It could be all sorts of things. It could be war, unlikely to be war, but it's going to be something. When you're watching Business Insider and you see, that's so interesting, I didn't know that company could go broke. It goes broke. Send me an email, okay, and then I'll start watching.
And how big a crash could we be looking at?
It's going to be the worst in your lifetime.
I've had some pretty big ones in
know,
my lifetime. It's long.
It's going to be the biggest in my lifetime, and I'm older than you. No, it's going to be serious stuff. It's going to be very. We've had financial problems in America. Let's use America. Every 4 to 7 years since the beginning of the Republic. Well, it's been over 8 since the last one. This is the longest, or the second longest in recorded history. So, it's coming. And the next time it comes, in 2008 we had a problem because of debt. Henry, the debt now, that debt was nothing compared to what's happening now. In 2008, the Chinese had a lot of money saved for a rainy day. It started raining, they started spending the money. Now even the Chinese have debt, and the debt is so much higher. The Federal Reserve, the central bank in America, the balance sheet is up over 5 times since 2008. It's going to be the worst in my lifetime too. Be worried.
I am worried.
Good.
Can the Fed rescue us? Can anybody rescue us?
They will try. They will. What's going to happen is they're going to raise interest rates some more. Then when things start going really bad, people are going to call and say, you must save me. It's Western civilization is going to collapse. And the Fed, who's made up of bureaucrats and politicians, will say, well, we better do something. And so they will try, but it won't work. It'll cause some rallies, but it won't work this time.
And we are in a situation where Western civilization already seems to be possibly collapsing, even with the market going up all the time. Often when you do have a financial calamity, you get huge turmoil in the political system. What happens politically if that happens?
Well, that's why I moved to Asia. My children speak Mandarin because of what's coming. You're going to see governments fail. You're going to see countries fail this time around. Iceland failed last time. Other countries fail. You're going to see more of that. You're going to see parties disappear. You're going to see institutions that have been around for a long time. Lehman Brothers has been around over 150 years. Gone. Not even a memory for most people. Well, you're going to see a lot more of that next time around, whether it's museums or hospitals or universities or financial firms.
Concerned, right? I mean, you're concerned about a signal or series of events that are going on that indicate the market could be in for something here. Explain.
This is an incredible pattern, Neil. It's something I discovered in the mid-1990s, and it was almost serendipitously. I was looking over at market data, and I saw a pattern. That pattern was it related only to the advances and declines on the New York Stock Exchange. I recognized that pattern as being something different. I put it into the computer, and I said, tell me when this pattern has happened before. And the computer ran, and it gave me these instances, like the top in 61, the top in 66, the top in 68, and it gave no other instances. And I said, oh my goodness, this is remarkable. So then I finally got the data going back to the 20s, and there was one signal, Neil, between 1926 and 1961, and that occurred in July of 1929. And I threw up my hands and said, "Oh my goodness, we really have something here." The sign of the bear doesn't know what Alibaba is doing or what Amazon's doing or who the new Federal Reserve chairman is or what's going to happen with interest rates.
It's
It
a
knows
technical
nothing
thing.
about
It's a
any of those
technical
things.
thing, right? So what?
Absolutely, Neil.
Tell us
Absolutely.
technically what it's picking up, what you're picking up.
Okay, what I'm picking up is that on October 5th, we had this pattern. I'll tell you what it is quickly, but I don't want to get too
Sure.
involved. It's 18 consecutive days where the advance decline ratio on the New York Exchange, advances divided by declines, is either below 195 or above 0.65. So it's kind of a churning range. That churning range turns into, if you get 18 consecutive days and you break out of that to the downside, in other words, with a ratio below 0.65, and you get 2 or 3 days of follow through, that's your pattern. And that's the sign of the bear. It's been incredible, Leo. The last one we had was in September of 2000, right at the top, within a week of the top of the New York Composite Index.
Wow. So in other
So
words, when that when that happens, and for a sustained number of days, how soon does the bad stuff happen?
That's a great question, and it varies. It's not a signal that says you better settle all today, get out of all your stocks today, or you're in trouble. In 1929, for instance, it took another 10% to the upside in about 5 or 6 weeks. There have been instances that's the longest you had to wait, by the way, price-wise, to see a move against you. But remember, after moving 10% to the upside in 29, we had a little move of 90% to the downside. So I would call that a well-timed signal. So that's the type of thing we're looking at here, Neil. One other thing I want to mention, 17-year cycle in the market. If you go back to the inception of the Dow Jones Industrial Average in the 1890s and look at these dates, 1898, important bottom. 1915, right around World War II, important bottom. 1932, important bottom. 1949, 17 more years, a kind of sideways move to an incredible move to the upside. 1966, the next 17 years, a very important top in the market, which lasted for 16, 17 years. The next one was due in 83. It happened 5 months early in 82. The next one due in 2000. I would say that's perfect, especially for the NASDAQ. And guess where we are now, Neil?
Wow.
2017.
Well, Robert Prechter had said, Peter, that he sees at least a 20% hit coming to these markets, which, of course, for a Dow would be close to 5,000 points just wiped away. What do you see? What do your charts tell you?
You know, if I were to tell you, Neil, and I know why Robert didn't do it either, we will be accused of bear mongering and telling people things to scare them. And boy, those technicians are out again, especially Eliades and Prechter are out there again scaring people, telling them.
Well,
it's the
people
end
who
of the
know
world.
your respective histories and respect what the research that goes into it, I don't think they would say that some do, but again, spell it out.
Okay, I'm spelling it out for you. I would say at least as bad a bear market as 07 to 09, at the very least. And that was more than 50%.
Yeah, that cut us in
So-
half. So let me ask you this. It's more of a political issue, and I know you don't take sides when you're just looking at the markets. You're not red or blue. You're just looking at the direction of the green or lack thereof. Yeah, when you see the president constantly talking about the records in the market and keeps going up, 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 there's a flip side to that, too. You own it on the way up, you own it on the way down, right?
I know. If I could tell Trump, President Trump, I'd bang him on the head and say, President Trump, you have to understand that you're going to have to own the downside too. And of course, he might very well think there isn't going to be any while he's in office. And the sign of the bear says something different. That's why I crawled out of my cave in Dunlap, California. I crawled out, Neil, and I said, really, people should know this. So I'm out of my cave, and I'm telling you that, Neil. And I have great respect for you for putting stuff like this on the air because a lot of the media don't want to hear it now. I've written several articles for Barron's. They don't want to hear about things like this. They think that they can prevent bear markets by not writing about them if there's an indication of them.
Yeah, but
the
Barron's has high praise for your sign of the bear, signs and all that, and a lot of people do. And I always think, to your point, Peter, it's only right to have both sides, the bullish and the bearish side. So, well, you mentioned the 1966 period. I believe then the Dow briefly pierced intraday, maybe 1,000. It didn't convincingly close over until 16, 17 years later. So what's to say that we have a market that doesn't necessarily tank 20, 30, 40, even 50%, but goes sideways for that long? Could that happen too?
I can't rule that out. I don't think that's going to happen, but we can't rule it out. All the sign of the bear tells us. And by the way, Neil, I should, in all honesty, say there have been 2 failed signals of the sign of the bear in 90 years. They occurred like 10 months apart in 93, 94, and I cannot explain them. There's nothing to say that we can't have another failed signal. I'll be the first to admit that.
But would a failed signal, Peter, would a failed signal to you, I mean, the argument against this happening, I know from a non-technical, more fundamental perspective, is that interest rates are very, very low. Balance sheets are very, very good. We have a very accommodated sort of a global Federal Reserve central bank phenomenon supporting this. So you don't buy that?
I'm glad you brought that up, Neil. Let's look at latest unemployment report, 4.1%.
Right.
Look at the 17-year cycle in relation to the 4.1%. You know when the last 4.1% unemployment was? The year 2000. You know what happened there. Go back 17 years, it worked the other way around. The high unemployment rate of around 10.5%. You go back 16, 17 years from there, and the cycle has worked very well with the unemployment rate. But one of the things that's scary, Neil, is the fact that we are at a 4.1% unemployment rate, and that has not been good for the market. That kind of good news turns out to be bad news for the market.
So tax cuts, whether they come to fruition or not, don't move the needle on this.
Yeah, that's one of the other things I was going to say. The sign of the bear doesn't know anything about tax cuts. It's incredible that this little 18, 21-day pattern that knows nothing about fundamentals at all it knows about is how many stocks are up and down for the day on the New York Exchange. How does some pattern like that pick out these turning points? I have no idea how it's done, Neil, but I know it's worked for 90 years, and so I have...
The market has been rising to new highs. You know why, right? Well, of course, we all do. Central banks have been printing currency like it's confetti and handing it out to corporations all over the world. A pervasive tactic never before done in history. This failure will be taught in books years from now as the worst monetary disaster ever conceived. And we're right smack in the middle of it. You came here for the truth, so let me unveil that for you. Today we are going to get into this bombshell news that I have for you. Let's look at this first. I've shown you this chart before, but I want to lead with this. It's very important. We are looking at the central banks around the world and their intentions, and that is to pull back on liquidity. It's not just one central bank or 2 or 3. They're basically all doing this now, claiming it's time to roll this back. Now, why have the stocks risen? I've covered this 1,000 times plus. The central bank intervention, quantitative easing, has pushed the stocks up. It has not pushed up all stocks because that's not how it works. They can't have such control unless they give the money directly to that corporation, which they have done before. But using their normal quantitative easing methods, they have to basically set it free and see where it goes. It has flown into select stocks. Those stocks have been rising and rising and rising, and we can see that they're at new highs all the time. Look at this. We are seeing the central banks pull back on liquidity. And what is the timeline for this? In the next 12 months. That's right. 12 months. They're going to be pulling back potentially greater than $1 trillion US in tightening in a 12-month period. That is a very large number considering what the central bank has done in recent years. I don't know if they're going to be able to do this without causing a crisis, but that's what they're claiming. You can see there are different amounts for different central banks here, but it doesn't matter. If they actually do go ahead with it, there's no way that this can be beneficial to the stock market. stock market has risen because of the central bank intervention, because of low interest rates. If they increase interest rates or if they decrease the quantitative easing, they pull back on the liquidity, we will have a disaster. There's no way to put this otherwise. That's the funny thing. There's a lot of talk in the financial media about the Federal Reserve and how they can't make a mistake. They need to not make a mistake. And what they mean by that is, we appreciate that you want to increase interest rates. We appreciate that you want to pull back on your balance sheet, but hold your horses. Don't go too fast. Take it real slow. Look at this. Okay, I have way too much information to cover today. I'll try my best to cover as most of it as I can. For anything that I don't cover that you see here, you can always go to the links in the description, check out the sources. The Bank of Japan now owns almost 80% of the entire Japanese ETF equity market. What kind of stupidity is that? And people believe in these markets. I mean, if you don't know that information, that's fine. But if you know it and you still invest, then I'm not going to judge anybody. You know where I'm going with that, right? It's crazy, truly. All right, back on it. The BOJ will likely be the major shareholder in 55 companies by the end of 2017. Bank of Japan holds 39% of Japan's government debt. That equates to 79% of Japan's GDP. It's absurd what's happening in Japan. There's no real investors in Japan. It's just the central bank. The Swiss National Bank bought $100 billion between the US and European stocks, $100 billion worth. It owns 26 million Microsoft shares. I've covered that on this channel before. I got laughed at. I got ridiculed. Proved it, shown you the SEC's website where it shows you that. People laughed at me. That's cool. Thanks. The listed stocks of the Swiss National Bank rose 120% in the last 2 months, almost 400% in 1 year. This has risen. It's unbelievable to see where it has gone. You've seen the stocks rising, but you've seen the central banks buying more shares. Does that equate? Does that correlate? Let me think about that for a second. Nope, no thoughts come into my head. USD denominated Russian bond yield trading below the treasury yield. And I think I have a chart on that in a moment here. Argentina uses defaults as a recurrent macroprudential policy to tackle debt overloads from time to time. 2014, 2001, 1989. Yet this year, the country issued a 100-year bond for a 7.9% yield. Red hot demand, oversubscribed 3.5 times. They've continuously been defaulting, going bankrupt. And then they offer this thing. They'll say, yeah, we'll give you 7.9%. Yeah, give me your money. And it was oversubscribed 3.5 times. I just don't understand this. This is when you know that it's all a fraud. It's all fake. Leverage to buy stocks on the NYSE margin debt hit an all-time record. Told you this before. And it went up in lockstep with the S&P as both doubled since 2009. Covered that as well on the channel. Is this 2007 over again for CLOs? No way. The covenant light loans are over double what they used to be in 2007. It goes on. Look, there's a lot going on here. There's so many different reasons why this market has risen, and none of them are real. It's all central bank intervention in one way, shape, or form. The central banks, the government, they're in collusion, the big corporations, and it's all of them versus you and I. But people still have faith, people still invest, and people fund these criminals. Let's move on. Income inequality is at its peak and going further. Look at this. Debt used to maintain the standard of living. Oh yeah, that has risen. Hours of work to buy the S&P. An interesting gauge here. I believe Mike Maloney covered this previously. Look at that. Same thing. We're seeing the dot-com bubble 2.0 happening. I mean, it doesn't even have to have anything to do with the tech stocks. It's just that euphoria. It wasn't even present during the 2007-2008 crisis. This is .com again, because it's becoming very stupid. How big a liquidity tide in 2018? This is basically the same thing that I covered earlier, but it actually tells you the descriptions here. The FOMC had committed to start cutting its balance sheet from October 2017 at a pace of $400 billion per year. Okay, it goes, I'm not going to go through them all here, but you're looking at $1 trillion or more US that's going to be pulled out of the markets. How do you think the markets are going to react? Now, surely another central bank like the Swiss National Bank could come in and fill in the void. Perhaps. Maybe they might see a discount, stocks drop by 10%, the Swiss National Bank comes in and buys it up. That might be the case. But even more distortions will occur as a result. Doesn't really matter to me. EU junk bonds yield less than US treasuries. All right. Looking at this here, we're seeing that convergence at this point. Junk bonds yield less than US treasury. The junk bonds are usually designed to get more yield, but nobody wants this garbage. That's what I think is funny. There's no value in these. Central banks panicking at the first signs of market weakness. Oh, Janet, shake it for me, Yellen. You are wonderful. Look at this. There's different dates that go along here. Back in 2014, Asian stocks jump on Yellen easy money remarks. Janet, what else do you say here? Going 2015, thank you, Janet Yellen, stocks surge after the Fed statement. 2016, stocks jump as oil prices rise and Fed chief Janet Yellen calms investors. Mama Yellen. Here she is. World stocks soar to record high after Yellen's upbeat remarks. That's 2017 February. Stocks rise. US dollar down after Yellen signals rate rise. That is March. Nothing makes sense anymore. Australia stocks jump on Yellen's dovish testimony. That was July 2017. Anything that they say brings these markets higher. They wait on their words. If you notice, the day before any of these meetings, a lot of times there's just like a wait and hold type of attitude, unless something is absolutely certain. They're always, okay, let's just wait until tomorrow. Volumes are lower, and you just see that. It's funny the way it works. When interest rates rose this rapidly in the past, it typically led to some stormy weather on risk assets. It's interesting. Looking at the right here, the 10-year US yield and market bubbles. Seemingly every time there's an upswing, a downswing follows it. Will we head in that direction? I don't know. I don't know that. But it just seems that way. That every time we're going up, we're following it with a down afterward. Down afterward. This is one indicator. There are so many. And last but not least here quickly, demise of the middle skilled jobs, change in share of employment by skill level since 1990, and globalization and income inequality. Does that surprise anybody at all? US wages and salaries as a percentage of GDPs, that's the blue line. Okay? That's you and me. Okay? Our earnings, what they actually buy, is just continuing to become worthless. More and more worthless. And every day, people around the world are telling me their stories, or people that they know stories, how they're suffering, how the conditions are getting worse. I hear it every day. Maybe you don't if you're looking at particular media, but I'm hearing this from people with their boots on the ground, feeling it in every single country. I've gotten emails from people all over the place. I visited people in different countries, talked to them, asked them about the market conditions, asked them about the economy, and I see it with my own eyes as well. US corporate profits before taxes, guess what? It's on a rise. It's no different than what is happening with these stocks. They're being pushed up. The collusion is there. We see it every single day, and yet some still deny it. If you found this video informative, please give me a thumbs up. Hope you appreciate my little rants, my little